When does a juicy dividend yield merely serve to disguise a dangerous value trap? That is the question that anyone taking a curious peek at UK housing stocks must ponder following the UK's vote to leave the European Union. This week, the UK 10-year bond yield rose slightly from the lows it hit earlier in the month, but it's still providing investors with a paltry 0.58% in income. Shares in British housing-related stocks have bounced a bit since the referendum, but do remain depressed, with many offering dividend yields at above 6% that reflect understandable uncertainty of the British economy and house prices. The market currently appears to believe that these stocks can only be bought with comfort if an investor has faith that the pre-vote structural drivers for UK housing will remain in place. Namely, these are a chronic shortage of residential property, government support for the housing market, and historically low mortgage rates. If Brexit deals a severe blow to the British economy, this argument follows that there will be a fall in land values and house prices, and this will mean that the book values and earnings of UK house builders will be severely impaired. But an alternative way of looking at this is that many house builders are already pricing in a severe slump, and right now they offer investors a tempting asymmetric bet. In 2007, before the crisis, investors were paid almost the same amount to hold UK 10-year debt as the gross yield on UK residential property. Since the crisis, this gap has ballooned as gilt yields have tumbled, with gross residential UK property yields sitting at about 300 basis points over 10-year gilts, compared to less than 50 basis points back in 2007. Shares in Berkeley Group, a house builder which is focused on the southeast, have fallen by 23% since the EU referendum, and at one point they were down by more than 30%. They currently offer investors a yield of 8%. Shares in another, Persimmon, which is focused outside of London, trade at 16% lower than they did before the vote and yield 6.3%. Both have net cash on their balance sheets and have made commitments to pay their dividends for the next 5 years. In a world where UK government debt provides ever-shrinking income, both shares are starting to look attractive.